Last week, Silicon Valley Bank collapsed, making it the second largest bank failure since 2008's Washington Mutual. Cool. So what does that mean, and how does it affect us? Let's find out. Since its founding in 1983, Silicon Valley Bank, SVB, specialized in providing loans, lines of credit, and cash management services to technology companies and venture capitalists. The bank's focus on technology allowed it to offer customized solutions that were tailored to the special needs of its clients. And their expertise in tech financing was a critical differentiator that helped it establish long-term relationships with the tech world. Unlike traditional banks, SVB did not offer personal banking services. The bank's focus on technology meant that it was not equipped to serve the needs of individual customers, with a few exceptions for high net worth individuals. Rich people. They only liked working with rich people. Silicon Valley Bank's marketing strategy was focused on building relationships within the tech sector, its target market. They focused on hosting events and programs like conferences, trade shows, startup accelerators, and other kinds of networking events. SVB also leveraged its expertise to create thought leadership content that was relevant to its target market. In fact, the very night of their collapse, they hosted venture capitalist Bill Reichert, who was giving a presentation on how to pitch your wow to investors. They sure wowed everyone with that disappearing act the next day, am I right? SVB worked with some of the most high-profile tech companies in the world. Some of its most notable clients included Google, Tesla, Dropbox, and Uber. One of SVB's biggest success stories was venture capitalist firm Andreessen Horowitz. They worked with them since inception, providing the firm with much-needed financing and cash management services. And in the process, established themselves as the leading provider of financial services to the tech world. So what the fuck happened? In 2021, the tech market was soaring and startups were raking in all the money. Literally all of it. All that money was being deposited into Silicon Valley Bank, which went from holding $62 billion at the end of 2019 to nearly $190 billion by the end of 2021. That's 300% growth in 2 years for all you math whizzes out there. Here's where the problem starts. Banks normally make their money by loaning out a portion of the money that they're holding, but SVB was taking in so much money that they couldn't loan it out fast enough. Instead, they bought long-term investments in the form of mortgage-backed securities, the majority of which matured in 10 years or more. 2008? Is that you? The most basic way to describe mortgage securities is a bundle of real estate debt they bought from banks that issued them initially. If they had held onto these securities to the 10-year maturity mark, they would have been guaranteed a profit. But if they sold early, they would have to sell them at market value, which could be a loss. I think you see where this is going. Late last year, the Fed started raising interest rates. This resulted in mortgage securities dropping in value. At the same time, tech companies also struggling with rate hikes started withdrawing money more quickly than they were depositing, depleting Silicon Valley Bank's coffers. To replenish their money stores, SVB announced a fire sale and sold $21 billion worth of liquid investments to raise cash and protect their long-term investments in mortgage-backed securities, taking a small loss in the process. Just a small loss of $2 billion. If it had ended there, SVB would have been fine. But what they clearly thought was a shrewd money move freaked out investors and VCs who started directing their startups to remove money from Silicon Valley Bank. The most notable of which was real-life Lex Luthor Peter Thiel, who was one of the first to push his investments to remove their money from Silicon Valley Bank. This triggered a bank run, and within 2 days, they were shut down by regulators and declared insolvent.
What the f*** is a bank run?
Good question. A bank run occurs when a large number of depositors withdraw their money from a bank because they fear the bank is insolvent or may become insolvent in the near future. The irony here is the bank run was what caused the insolvency of SVB, a classic chicken or egg dilemma. So what happened to all the money that SVB was holding? Deposits insured by the FDIC will be returned to their owners if they haven't already. But as of their last filing, 93% of the bank's $162 billion deposits were uninsured. That's because the FDIC will only insure $250,000 for each account. But there's still hope. Based on SVB's liquidation plan, it's likely that all depositors will get their money returned eventually, though no one has any clue when eventually is. So how does this affect you? Companies who banked with SVB are struggling to pay their employees today because, well, they don't have access to their money anymore. If you work for one of these companies, you already know you're probably not getting a paycheck for a while. But that's not all. Even companies that don't bank directly with them can be affected by companies who do. If your company uses payroll software Rippling, for example, you may not be getting a paycheck this month because Rippling processed paychecks through Silicon Valley Bank. And that's one of many examples of how SVB's collapse is rippling throughout the tech world. No pun intended. What about other banks? Are any other banks at risk too? It's hard to say, but we do know Signature Bank, a small bank out of New York, also collapsed last week. So it's not looking great. While big banks like JP Morgan Chase, Bank of America, and Wells Fargo are pretty safe because the government has deemed them too large to fail, SVB was only the 16th largest bank in the US, making it clear the smaller banks are not impervious to collapse. President Biden himself came out and said there will be no bailout, so small banks are on their own. Don't panic, I'm sure all the rich people will be fine. Small business owners and everyday folks all over the country are concerned that their small or local banks could fail, triggering a fear for more bank runs in the future, especially as our economy continues to slow down and the Fed continues to raise interest rates. But really, don't panic. The situation got the ball rolling on talks for more oversight and stronger regulation on banks dealing with your money. How well those talks will go is up in the air, but the last thing anyone wants is another bank system collapse. There, now you're an expert. If you enjoyed this video, like and subscribe below. I release a new video explaining how different companies do business every week, so hit that notification bell below too. Cool, thanks.